Hello everyone, welcome back to StrideRise Finance. In the last video, I discussed what my thoughts were on the investment strategy of ARK Invest as discussed by their CEO, Kathy Wood. In this video, we will discuss a few ETFs in the technology innovation space which I feel are better alternatives to the ARK ETF. Let's check it out. I have no doubts that technology will be a key factor in our daily lives. Innovative thinking is key to a company going from obscure to being hailed upon. Take Tesla, for example. Who would have thought a company which was on the verge of bankruptcy when it started would take on the electric vehicle space like no other? Likewise, nobody gave Apple any thought in the early 2000s, and see what iPhone did to the company. It did not stop there but kept on building products which have now become an integral part of our day to day life. So, yes, some portion of your portfolio should be allocated to companies or ETFs in the technological innovation space. We have VGT from Vanguard or QQQ from Invesco to talk about in this space. These funds have been stellar over the past many years now. What I wanted to discuss here further are few ETFs which I feel are better alternatives to the ARK Innovation ETF, which investors may consider adding to their portfolio. The first ETF we have is Loop, LOUP, from Innovator ETFs. So just let's look at the ETF summary. The Innovator Loop Frontier Tech ETF seeks to provide exposure to the investment results of the Loop Frontier Tech Index, which tracks the performance of companies that influence the future of technology, including but not limited to artificial intelligence, fintech, robotics, autonomous, and electric vehicles, and virtual augmented reality. So this ETF started in July of 2018. It has 30 holdings, so the portfolio is very much concentrated, and the expense ratio is 0.7. When you look at the top 10 holdings, we have Nintendo, Snap, Unity, AMD, 26, Micron, Baidu, SK Hynix, Lumentum, and JD Logistics, which basically called holdings. And after that, we see ASML, Aerovironment, Signature Bank, Teradyne, Skyworks, and Affirm, Umbrella, Novanta. Scrolling down to the sector weights, we see almost two-thirds of it is in information technology. The remaining are spread across industrials and financials in a major way. And then we have communication, energy, and consumer discretionary, just rounding off the final pieces. And it has around 72% in the US, and the rest are spread across different countries. Here, when we compare the performance of Loop with the ARK Innovation ETF, we see year to date it's minus 17% compared to ARK's minus 32. Over the last year, Loop has minus 28 compared to almost 57 plus percent of ARK, and over the last 2 years, it's my 47% compared to ARC's 11%. And when we look at 5 years, of course, the Loop fund didn't start 5 years ago, but still, if we look at the relative performance, Loop has 75% versus 43 for ARC. So across all the time frames, Loop has beaten ARC. So this ETF with a very concentrated portfolio of 30 holdings and a high expense ratio of 0.7 is similar to ARC. It's just that it is performing well now. We never know how it might do in the future. So it can be put on the watch list. Next, we have BTEC from BlackRock. It also has a very high expense ratio of 0.88. When you look at the details of the CTF, you see diversified exposure to innovative companies within technology, seek out performance by accessing industries that can shape the global economic future. So this is a fairly new fund that was launched less than 2 years ago in September of 2020, and we see it has 98 holdings. When you look at the top 10 holding, the top holding right now is cash at 3.83%. Then we see Marvel, Tesla, Synergy, On Semiconductor, Integris, Lightminder, Indava, Kakao, Monolithic. And here, looking at the sector breakdown, more than three-fourths of the fund is in information technology, and we have communication, discretionary, industrials rounding out the remaining. And look at the geography. Almost two-thirds is in United States. The remaining is spread across. Looking at the performance of this fund against the ARK Innovation ETF, year to date we see BTech falling more than 25% versus 31.5 for the ARK. For the last year, it has minus 37% versus minus 57 for ARK. Over the last 2 years, though the fund started in the September of 2020, from then till now, comparatively, we see BTech having 1.42% versus minus 30 for the ARK fund. So, in my opinion, BTech ETF being fairly new is yet to be tested, and one needs to really understand how it behaves over different market cycles. And that's where we move on to our third fund. The third fund in our list is XT from iShares. This is the iShares Exponential Technologies ETF with an expense ratio of 0.46. So it is much less compared to the ones that we saw earlier. Looking at the details of this ETF, it looks at innovation leaders, access global companies with significant exposure to exponential technologies, which displace older technologies, create new markets, and have the potential to create significantly positive economic benefits. Employs a unique process that evaluates global stocks of technology producers and users across 9 technology themes, spans global sectors, look to capture potential growth from firms driving technology advances across all areas of the economy. So this fund started in March of 2015. So it does have a decent history of almost 7 years. You look at the holdings, it has 200 holdings in the ETF, so it is well diversified. When you look at the top holdings in this ETF, we see Citrix Systems, Sabre Corp, CF Industries, Bristol Myers Squibb, AbbVie, Exelixis, Norton LifeLock, Takeda Pharma, Shanghai Junshi Biosciences, and Baidu. When we look at the exposure breakdown, we see the top sector of information technology has just over 50%. So in our earlier two funds, what we saw was the information technology was almost 75% in both these funds. So here we see information technology is having just over 50% and healthcare almost 24%, and the rest are spread across. From a geographical standpoint, 60% of it is in United States and the rest are all spread across. Coming to the performance of this fund, year to date, XT has minus 15% versus minus 31.5 for ARK. So it's almost half of that. For the last year, it has minus 9.17 versus minus 57 for ARK. For the last 2 years, it has given 25% versus 10% for ARK. And because this fund has a long history, we can also look at the 5 year performance. Now, this is where ARK beats out the XT because ARK had a wonderful year in 2020. So just because of that 1 year, what we see here is ARK giving almost double the performance of XT. So just 1 year makes a lot of difference. Overall, XT is a good ETF to consider, considering it is less expensive. It has 200 holdings, so that's a fair amount of holdings. So it's not concentrated into top 10 or anything like that. And also, it has almost 7 years of history, which is a good thing to look at. The fourth in our list is my favorite of all, which is COMP, KOMP. That's the PIDA S&P Can Show New Economies Composite ETF. It is from State Street. It has a very less expense ratio of just 0.2%. When you look at the details, the ETF seeks to track an index utilizing artificial intelligence and quantitative weighting methodology to pursue potential of new economy fueled by innovative companies, disrupting traditional industries by leveraging advancements in exponential processing power, artificial intelligence, robotics, and automation. This fund started in October of 2018, so it has like 3.5 years of runtime till now. When you look at the holdings, it has 569 holdings in it. So this ETF is very, very diversified. No one particular stock or area like hogs the entire thing. Looking at the top fund holdings, we see Teledyne, Brooker, Vonage, Albit, Toyota, Visteon, ABB, Cisco, PTC Inc., and Leidos Holdings. For the sector breakdown of this ETF, we come to this website, ETF Research Center. And here, when we look at the sector breakdown, we see technology has 38.1%, industrial is almost 22, healthcare is 12%, discretionary is 10, and the remaining is spread across other sectors. And when we look at the country breakdown, the US has 75% of allocation, and the remaining is spread across other countries. The Comp ETF also has a 4-star rating from Morningstar. When we look at the performance of Comp ETF year to date versus ARK, it has minus 16% compared to minus 30 2 for ARK. Over the last 1 year, comp has minus 33 versus minus 57 for ARK. Over the last 2 years, comp has generated 27% returns versus 11% for ARK. When we do the 5-year comparison, though comp has started in 2018, we see it has generated 74% returns versus 58 for ARK. So overall, comp is a much less expensive ETF compared to ARK, and investors should consider comp and XT as their ETFs to pursue the innovation space. Thanks for watching. If you have liked this video, please click on the like button and subscribe to my channel to keep informed of all such informative videos in the future. I am not a certified finance professional, and all my videos are for educational and entertainment purposes only. Please contact your financial planner for your individual investment needs. Thanks. See you in the next video.